Wallfacer Labs Q3 State of the RWA Market. I put this presentation together because I think it gives a lot of context and color to what we're working on for TrueFi, and at this point where we think it makes the most sense to focus both time, energy, resources, and all of those finite things. So this presentation is prepared by Wallfacer Labs. We are a crypto research and development company. Today we are core contributors to TrueFi and are also building some data products of our own, like vaults.fyi, which you can check out. So some quick disclaimers. I'm not updating this presentation daily. Numbers move around a lot, but in general, most of the numbers here have been gathered between January and August of 2023. The presentation is intended to be a bit entertaining. Please don't take anything I say personally. And then lastly, the presentation is definitely a bit opinionated, and I would very much love to hear dissenting opinions, and I and we here are certainly always open to changing our mind. So when people say RWA, what do they actually mean? I suppose the short answer here is some kind of on-chain representation or yield that's associated with assets that are not inherent to a blockchain. In a rough kind of 2x2 or mapping of the players in this segment looks something like this. The only vertical here that's really taken off is what I would call institutional and off-chain. And that's very much shown in the data that I'll cover later in a bit as well. Digging into that a bit more, you can see TrueFi, Maple, Goldfinch, Centrifuge, Ondo, Credix, Atlendis in this similar type of bucket in my mind. They're all very similar in how they represent off-chain assets on-chain, at least in terms of the types of credit and things like that. And then there are things that are still institutional focused, both in the borrowers and lenders, but maybe are a bit more off-chain. I point to Clearpool and Ribbon here, who both use utilization curves. TrueFi does actually have a similar product called ALOX, though it hasn't been utilized much so far. Flux by Ondo, which I'll again talk about later, is certainly much more in the on-chain category, but still, since the borrowers and assets are off-chain, I put it close to the line. So how do these protocols actually work? Because I think maybe there's some misunderstanding here. Most of us have three roles in our protocol: a lender and a borrower, which are very self-explanatory, and then a manager, which sits in between the borrowers and the lenders. At TrueFi, we call this a portfolio manager. Maple calls it a pool delegate. Centrifuge, I believe, calls it an underwriter. But basically, these are the people that raise and deploy capital, and in most cases are making underwriting decisions on the individual borrowers as well. This is different as most DeFi protocols don't have a role like this, but our protocols, of course, do. And within this model of the underwriter or portfolio manager, there's really one big question. Is the manager external to the protocol team or embedded within? Today, TrueFi, Maple, Centrifuge all use external managers to launch pools on their respective protocols. So basically just being a piece of on-chain infrastructure. None of our teams have internal teams that are underwriting individual loans. Maple actually did just reintroduce a concept like this with their new Maple Direct, but in general, all of us use external managers. Credix and Ondo are different. Credix, from what I can tell, has an internal credit team that's underwriting individual borrowers, and Ondo, as I'll cover later, has an internal asset manager that's going out and buying the T-bills on the lender's behalf. At TrueFi, we started in the model of having credit done in-house. In the early days, I think this is very useful. You get to dog food the product, you're fully aligned with the growth of the protocol, but over time you realize that the model does not scale great, and it raises conflict of interest questions if you want to attract external underwriters while also having internal underwriters that might be doing similar types of credit. As such, we moved away from having any credit professionals employed by TrueFi or its associated entities that are doing any kind of underwriting. So now let's dig into kind of the state of the market and see where we are today. So in my mind, there's about 5 or 6 protocols who have done any kind of notable volumes in RWA. TrueFi, Maple, Goldfinch, Centrifuge, Credix, Clearpool, Ribbon to a smaller extent, things like that. And I think it's kind of clear looking at the hump here, but using this data from RWA.xyz, we can see that the market peaked sometime around Q2 of 2022. At that time, the only significant protocols, just kind of subjectively measured by doing more than 100 million in loans outstanding, were TrueFi and Maple. Clearpool around that time was also kind of beginning to peak, I think at about 100 million as well. And so at that point, I believe, or I should say at this point, I think everyone has kind of woken up to this new reality that we've kind of erased, where we are today in 2023, we've gone back to 2021 levels of size. And I think everyone's asking the question of what do lenders actually want? And at TrueFi, we spent a lot of time both thinking about this, researching this, and most importantly, speaking with lenders and folks in the space, including people who used to allocate capital to TrueFi, to find out what people want. And I think the difficult answer is that there is no clear answer amongst those people. So digging into this, let's look at the actual numbers that made up this chart. So in total, the kind of on-chain credit space has done $4.4 billion worth of loan originations. 86% of that, $4.3 billion, comes from lending to crypto trading firms. Of that $4.3 billion, 80% is TrueFi and Maple alone. I think TrueFi was 1.7, Maple's about 1.8. So that's $3.5 billion of lending to crypto trading firms. Of the remaining about $600 million, $152 million of those originations are emerging market credit across Goldfinch and Credix. And then the remainder is centrifuge, most recently as a result of their engagement with BlockTower and MakerDAO. These figures, of course, don't cover tokenized securities like Ondo and Matrix Docs product, but we'll come back to those later as well. So when you dig in, the question I kind of found myself asking for a while was, why were people so interested in lending to crypto trading firms? And I have a very just sort of simplistic 5-pronged thesis. So when you dig into what made TrueFi and Maple's market-making lending attractive, this is what I think it is. 1, they were easy to understand. People could understand I will lend $10 million to Wintermute, they will use it for leverage. Their CEO is on Twitter, I can message them easily, I mostly trust them. This is less true for, say, a firm that's doing receivables or trade financing. Their businesses are less well understood, the capital can't be as easily tracked on chain, and their key people are certainly less accessible. 2, the loans were generally short-term, and our pools didn't run at 100% utilization. The longest loan TrueFi ever issued to a market maker was 180 days, and I think Maple was the same. In addition to this, the loans were originated in broader, diversified loan pools that often didn't run at 100% utilization. So if as a lender you wanted to exit after, say, 25 days, you often could, even if most of the loans were 60, 90, 180-day loans. 3, the yields that lenders received were generally always above 10%. Through a combination of strong demand, at some point, borrowers were willing to pay upwards of 18% for stablecoins, and of course, token incentives, the yields on these pools were always very attractive. 4, even though this wasn't really utilized on TrueFi or Maple, both of our pools at the time had tradable LP tokens. And so in theory, this gave lenders more comfort to exit or swap out of a position early, even if in practice it basically never happened. And 5, at the time of the peak in this market, no credit protocol had ever seen a default. And I think that there was a bit of, bliss or innocence that we wouldn't see one. But obviously this isn't the case. It's not the reality of doing credit. Today, the market feels much different about lending to trading firms in the previous format. It's possible that there will be another wave. I think Maple's betting on this with their new Maple Direct product. But with yields at less than 10%, I don't see a lot of lender intrigue, even if loans are collateralized with off-chain custodians. And I am, not cautiously optimistic, maybe like observantly skeptic, where I'm certainly willing to change my mind if I see this market coming back. But at this point in time, I don't exactly see that. Moving along to some of the actual protocols now. So in terms of investor base, I think Credix has probably got the best. They have the most strategic investors, including well-known credit funds like Victory Park or firms like Clark Group, which have strong ties into Latin America, where Credix's core market is. Additionally, one of Credix's co-leads in their last round, Motive Partners, is partially owned by Apollo, which has allegedly been a large investor into the Credix senior tranche, and I think the Motive team has been working with Credix on developing strong underwriting standards. It's worth noting that Credix doesn't have a token, and they've raised a fair bit of money, so they're well capitalized for a while to experiment and try out different things. In 2023, their decision to launch on Solana might look a bit odd, but from the outside, I don't think that's been the particular hindrance of growth or anything. They seem to have recently experienced their first set of redemptions, as displayed here in the chart where things are going down. Their website says the TVL is a bit higher, but I'm not exactly sure what's true. But if we did take the higher TVL from their website, it's closer to about 37 million. So, Small, kind of deliberate growth. Going back to my earlier framework, right now they have their underwriter in-house. So again, I think it makes it easier for them to experiment and test things out, and we'll continue to track and see where things go there. Next up is Maple. I give them a lot of credit for continuing to try and launch new products. Most of them seem to have been pretty tough to get off the ground. In some respects with their new Maple Direct product, it seems like they're going kind of back to building blocks and day one type of mentality to be able to move a bit faster. Maple's TVL today is a bit tricky to pin down. RWA.xyz says it's 130 million. DeFi Llama says it's 50 million. Maple's homepage says it's 52 million. I'm going to make the somewhat subjective call here of excluding loans that are in recovery, so the Oros loans and I think the orthogonal loans. And so if you do that, their TVL today is about 42 million, where 64% of that is T-bills and the remainder is their receivables pool. So, they've tried to launch a couple things recently. The Bitcoin miner pool wasn't able to get off the ground. I think that was just a tough time to launch something like that. The receivables pool has not hit this $100 million liquidity mark that they laid out yet, but it's certainly showing some growth. Today it's got $15 million worth of loans outstanding, and they've been able to recycle that capital a couple times for $50 million worth of total originations. Maple is also kind of going through an interesting tokenomics revamp at the moment. They are basically proposing to increase the total supply, which obviously is controversial. They've talked about doing this in the past with their expansion onto Solana, but that didn't happen. And so I'm very curious to see where this ends up this time around. Goldfinch, is of course a much different protocol. They're focused on emerging market credit. I think the reality, for all of the goodness and great stuff that they do, the growth of the protocol can really be summed up in this one chart of their active loans. Basically, no growth or decline since, April of 2022, so about 18 months now, which is surprising. However, the reason this is the case is because in 2021 and 2022, they entered into 24 to 48-month loan agreements where principal capital is locked up with maturities that don't come due until 2024 to 2026. At the same time, Goldfinch also just went through their first default, and so as you can see on the right here, that has impacted the senior pool APY, and I think it's actually closed for deposits at the moment, but overall I think maybe we'll make growth in that pool a bit more difficult, as that's actually where the majority of their lender capital has come from. I think last I looked, So 78 million worth of total capital in Goldfinch actually sits in the senior pool, and then the junior tranches, I guess, have only raised about 20 to 30 million. So if this rate is going to stay relatively low for a bit, I think that could make new capital tough. This is actually kind of an aside, but this was an analysis we actually ran last summer, so this data is old. This is from August of 2022. But it's kind of interesting because, at the time, I think we felt at TrueFi that we were getting, kind of lapped by competitors just in terms of growth. But when we really dug into this, it was clear that, we were actually kind of on the lower end of incentivizing our pools. And so, maybe cope, maybe actual rationalization, but that was kind of our thinking at the time. And with Goldfinch, they were spending kind of a moderate amount, and they're actually at a spot now where they, just in March, had to basically redo their junior and senior LP token incentivization a bit so that they could extend it out. Otherwise, they were going to run out of token incentives in June. But again, just something to watch with a lot of these protocols. I think in part this actually might be, I guess they said as much as well, but I think this is also why Maple is expanding their token supply so that they have more to both incentivize borrowers, lenders, portfolio managers, and team, things like that. So moving on to Centrifuge, historically, Centrifuge has really been the leader in the RWA space. They have been slogging away at this market since, 2018 maybe is when they were founded, 2019, something like that. And the reality is that, I think that they've built a lot of sophisticated infrastructure. I think it can be difficult for participants to understand sometimes, but, at the same time, it's very robust. And they were really kind of in a spot where they weren't able to crack that, somewhat symbolic 100 million loans outstanding line until the recent block tower deals began with the kind of tri-party relationship of Centrifuge, block tower, and MakerDAO in the beginning of 2023. And so when you kind of look at the outstanding loan chart today, there actually is not anything showing meaningful growth outside of block tower. And, truly, just in case someone from Centrifuge is listening, that's not a dig at Centrifuge, more just a commentary on the space overall. And so today you can see the block tower outstanding loans on Centrifuge are about 75% of total outstanding capital. And when you dig in a little bit more, you can actually see that most of their pools are in decline or shrinking, Fortunify, New Silver, etc. Several of their pools, I think 6, 7, are just flat since the beginning of the year. And then there's 2 pools that are growing. Alternative SPV has gained about $2 million worth of TVL, it appears. And then Block Tower obviously has grown a tremendous amount. And, I actually don't know what these negative numbers on Paper Chain and Gig Economy represent, but, just doing's not perfect. So this is kind of where Centrifuge is today. Obviously, Block Tower is playing a huge role here, and, we'll continue to follow them closely into the future. So bigger picture, I think, is kind of where we are. So taking a step back, what do I think is going on here? As I talked about earlier, historically, this market was driven by lender interest in getting yield from crypto trading firms. That market has all but dried up following some of the defaults on TrueFi and Maple's platform in the fall of 2022. While most of these loans are in active recovery, and at least from what I've heard from the Archblock team, what I've seen from Maple, the recovery processes seem to be going pretty well. And so I think actually lenders will get decent recovery value on both of these. Not financial advice, not legal advice, just my opinion. However, I still think that lender interest is a bit soured on some of these opportunities right now. I also think at this point, the quote-unquote bid-ask spread between what lenders expect and what borrowers want to pay is probably a bit mismatched. My guess is that lenders probably want, if a lender was going to lend to a crypto trading firm today, they probably want exposure in the 12 to 15, if not higher range, especially if it's without collateral posted on chain or with a custodian. So I don't know. I don't see this kind of coming back in the short term. And so, in many ways, I think it's these defaults that really led to this decline of this market more so than anything else. And again, it's not to say that it won't come back. We would love it to. I just don't think it's there right now. I think now we're kind of entering the second wave of default in the summer of 2023, where Centrifuge has 3 or 4 pools that are facing defaults. Goldfinch just had their first $5 million default that exclusively impacted their senior tranche pool. And so I think we're going to see increased hesitation in this more type of discretionary credit across the board. Also, just a small shout out to Christian Sandor at CoinDesk, who has written 7 of the 8 articles that I show on these slides. He's definitely the best journalist who covers our sector. So now let's move on. Now that we're kind of past this more discretionary credit, let's get on to U.S. Treasuries, which are obviously showing a lot of growth. Today, the U.S. Treasury on-chain market sits at $323 million. This data comes from a Dune dashboard created by Steakhouse Financial. This chart, of course, excludes the Franklin Templeton product that you will see if you look at RWA.xyz data. I agree with that decision. I don't understand the Franklin Templeton product well enough. I don't think it's on-chain enough to kind of meet my standards of what's interesting, so I exclude them. But, as you can see, this market has grown pretty steadily since the beginning of this year. So the first player to really enter this market, and actually Bakkt might have been first, but I'll just talk about Ondo since they kind of kicked off the market. Ondo is really kind of 2 things to me. On the left side, Ondo is just a traditional asset manager. I believe they're based in Greenwich, Connecticut. They've got service providers, a GP/LP structure, everything you'd expect of a fund. On the right, then, is actually this interesting and kind of innovative permissioned, semi-permissioned DeFi protocol called Flux. And Flux at its core is actually something fairly simple. It's a Compound V2 fork where today at least, the only asset you can use as collateral is Ondo's OUSG product. Or maybe actually their new products as well. I'm actually slightly out of date. But this is basically a roundabout way for Flux users to make their LP token into a productive asset. They can post OUSG as collateral and then borrow permissionless assets like DAI, Frax, USDC, and Tether, and then loop those to buy more T-bills, a classic kind of looping leverage trade to get more yield for those people who are willing to go through the Ondo KYC. Now, beyond what Ondo is doing with some of these products, they're also launching some other things. OMMF, which I think is supposed to be pegged to $1, and some different kind of things like that. A lot of people try to make and compare stable coins to T-bills. And, analogy that I've made a couple times in the past is that, there's this conversation in the market of why would you hold ETH if you could hold STETH instead? Obviously, there's some risk, et cetera. But, it's a first order thing. I think maybe what Ondo sees here and Flux sees here is, why would you hold USDC if you could hold FUSDC and not get some yield exposure? I think, a similar kind of thing exists with DAI and CHAI and the DSR. But I think ultimately, we'll see if that kind of plays out. But again, it's kind of a narrative and broader theme of things I'm watching in terms of what we could maybe build next. Moving along is Matrix Doc. Matrix Doc is a kind of subsidiary entity protocol, whatever you want to call it, from Matrixport. Matrixport itself is, of course, a spin-out of Bitmain, kind of focused on financial products for Bitcoin miners and other types of miners and stakers at this point. It's grown pretty healthily as well so far. Today, the total supply is 71 million. I don't really have much to add on this. It's somewhat interesting just in terms of a product. I think it's great to see this kind of growth. As you can see, the supply's actually come down a bit. I missed that, but it looked like it was maybe at 120. Now it's back at 70. Still great. I think that they're the second largest in the market at this point. Actually, something I'll talk about on the next slide, but something kind of interesting and notable about both Ondo Flux and Matrixport is that they both allow users to do things with their respective LP tokens. Matrix Doc has a semi-permission curve pool so that lenders can get early liquidity. Ondo has Flux, where holders can borrow permissionless capital to lever up their T-bill exposure. And frankly, it is still TBD to me where a lot of this market is going to shake out from what you can do from a legal perspective. A more conservative legal point of view, which we've been trying to follow so far, would say that any kind of transferability or commingling of these assets is not something that you can do with securities. This is why, frankly, we have not launched a response to Flux, even though this is kind of obvious to say, but it's not too difficult to launch a Compound V2 fork. That said, we're actively exploring other options that we think are more compliant and legally conservative, but nothing to formally share there yet. I would like to, but I kind of don't want to give away all of our plans yet. Moving next to MakerDAO. It'd be tough to talk about RWA without talking about Maker. An observation that I had last summer, this is June 2022, was that crypto yields basically live in this interest rate bubble. If anything, they work kind of inversely correlated to broader market yields. So as we saw traditional market yields go up, we saw pretty poor yields on Compound and Aave. And I think maybe Maker has kind of realized this. And on the right here is Sam, the founder of Spark Protocol. Spark today, as you can see here on the left from Vault.fyi, a new product launched by Wallfacer Labs, the DSR is paying out 5% yield. This was up at 8% for a kind of short introductory period of time, but today is at 5%. And this is basically comparable with what our T-bill products are paying. I think all of our products are paying between 4.8 and 5.3%. So the DSR kind of sits squarely in the middle there. And if essentially what MakerDAO is doing here is saying, hey, we have all this T-bill exposure. Let's pass along this yield to lenders to grow the DAI supply. This to me is quite interesting to follow. And at least from kind of a form factor perspective, it's easier and there's no KYC required to participate in the DSR, whereas obviously that does exist for every T-bill product that is in the market today. So again, we'll see where this kind of shakes out. Ultimately, it's, the DSR at this point is mostly just T-bill exposure, and I think it's just, slightly a different form factor. So that's kind of where we are with this. And again, definitely check out vaults.fyi. Moving along with MakerDAO, they have a lot of RWA exposure today. I think if I've done my math correctly, they have $2.4 billion worth of RWA exposure. That is a mix of T-bill products. So Monetalis, which is 42% of this exposure, is all T-bills. Coinbase Custody, I think is T-bills or something like that, but it's paying out about 4%, I believe. Block Tower, of course, has a lot of deals here as well. Most of that is now T-bills, so 652 million. Block Tower Andromeda, that's all T-bill exposure. Then there's also Block Tower 3 and 4, which are more discretionary credit. And when I look at these kind of MakerDAO deals today, I think it's safe to say that a lot of these deals like 6S, New Silver, Console Freight, Harbor Trade, Fortunify, maybe even Block Tower 3 and 4 probably would not happen in today's environment. And I don't get the impression we're going to see a lot more of these like these going forward. I think Block Tower 3 and 4 are actually financed at 4%, which given that is less than the current U.S. Treasuries rate, you have to wonder if these deals would get financed again today. I think probably not. So then you have to ask the question, if these deals were instead financed by MakerDAO to Block Tower at like 6 to 7% for senior capital, would that still be appealing to Block Tower? I don't know. At the very least, even though obviously these were exciting, I don't think we'll see another $100 million HVB-like deal anytime soon, though I would be very excited to be proved wrong on that. And now, finally, to TrueFi. So at this point, we've done, I think, in the past few months, a great job of decentralizing most of the core pieces of TrueFi's building blocks. We've built out and launched a lot of key features, asset vaults, 4626 compatibility, tranching, waterfall repayments, all of these features that people have wanted. And going forward, we want to make it easier for managers to, spin up pools with little, I'm jumping ahead of it. So our top focus going forward, I should say, is a focus on T-bills and similar types of products. Things that are easy to understand, fungible, short-term, and can offer a reliable yield. My focus going forward is to do everything possible to help Marcus and the team at Adapter succeed. One of the ways we're thinking about doing this is by expanding onto EVM-compatible L2s and trying to be the first player on some of these different markets. I think specifically when I say that, what I mean is we want to have close ties with either DAOs or foundations of these L2s so that we have an aligned partner. So, for example, if random L2 was willing to commit, say, $10 million out of their treasury to invest into our T-bill portfolio, we would happily, try and launch on that chain. All things considered, I'm sure there's some nuance on that, but all things considered, that's kind of the stuff that we're looking at the moment. We're looking for big ticket ways to grow the T-bill portfolio. And then lastly is kind of focusing on some of these managerless products. So we want to make it easier for managers to spin up pools on TrueFi with little to no handholding. This is kind of actually a TBD on whether or not it will lead to a lot of growth, but at the very least, it does open up TrueFi for more experimentation, which could lead to something. And we also, look out for a future proposal to open source some legal docs as well to decrease, hopefully, some of the onboarding costs for managers who want to come on to TrueFi. Of course, outside of that, we'll continue to do what we've always done. We're continuing to talk with traditional firms and asset managers. Actually, I'll give a shout out a little bit more on the Archblock side. They're doing a lot more of this, but talking to them about launching on TrueFi and trying to get them on board. We're also very upfront, though, about expectations in terms of raising capital. We can't promise anything, et cetera, et cetera. And if they're willing to really kind of be a partner and experiment with us, then we're happy to do that. So that is the presentation. I hope you found this interesting, useful. If you want to get in touch and debate anything in here, please reach out to me. I should put my Telegram handle here, but it's just my full name, Ryan Rodenbach. So thank you, everybody, and talk to you soon.